Well, hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have you with us in the third week, if I'm not mistaken. Yeah, the third week already. Principles of Accounting 2 here at UDC in the spring 2024 semester. I just want a couple of points of note. I want to first and foremost congratulate all of you on a very job well done over the past 2 weeks. Everyone has been really good about getting the work in on time. So, number one, thank you for that. I really appreciate all of that. I also appreciate the fact that you're all doing very well in the course so far. So kudos to all of your work and all of your progress. I feel that this is a great course. You're all doing very well in the course, and I couldn't be happier. So thank you, thank you, thank you. You all deserve a round of applause for that for sure. Because the progress that I'm seeing is just really awesome. So thank you so much for your hard work. It means a lot to me, and I'm sure it means a lot to you as well. So last week we had a great conversation on analyzing financial statements. We talked about the three primary methods like vertical analysis, horizontal analysis, and of course the ratios, which is one of your favorite ones. I know that it is. So the reason why we talked about that last week is because it helps to us to bridge together principles of accounting one, from what you remember, and into principles of accounting two. As I mentioned last week, one of the primary reasons why we go through analyzing financial statements is because as managers, we need to better understand exactly the financial health of the business. In principles of accounting two, we focus on that managerial side of the business, which is why last week we went through the exercises of analyzing the financial statements. In this week, we're going to focus on what this course is all about, and we're going to talk a lot about cost. Okay, so that's what we're going to cover today. And so before we jump into the presentation, just to quickly remind you where we are in the classroom, we are in week 3 already, which is awesome, by the way. I need you to go through all of these files just as you normally would. The week at a glance, and then the instructional materials. The instructional materials here in this document, you'll find the PowerPoint that covers today's lecture. You'll also find some additional information that I've written for you just to kind of summarize some things. And there's a couple of LinkedIn Learning, just videos, yeah? They're just videos. Just videos to help you kind of reinforce what you're learning, yeah? So there's a couple of videos that are after here. Just feel free to watch those if you want to. Again, they're just additional content to help to reinforce your learning, yeah? So once you've gotten through those, uh, and after today's lecture, for Wednesday, I want you to be working on the hypothesis for this week. Now, you might be wondering, Dr. B, what is a hypothesis? I've never done one. The way it works is you will be annotating parts of a video. Okay, this is a little bit unique to this course. Here we have some instructions. If you want to watch the video of how to do it, you can. The way it'll work is you can uh, ask questions, comments about the video. That'll be your original annotation. The way it works is you'll click on the hypothesis. It'll open up like this. Whoop. Well, hopefully it doesn't open up like that. It should open up with a video. The video will begin playing. There will be a transcript of that video. You'll highlight the parts of interest and you'll create what's called an annotation. It's kind of like a note. You'll click submit, and then what I want you to do is respond to at least one of your classmates' annotations. Okay, it's kind of like a discussion board, but it's in like a video format, and you make comments, and it doesn't have to be anything too long. Okay, a sentence, couple sentences, that's fine. The point of the hypothesis annotation is to help you to kind of reinforce the content that we're learning this week. Yeah. So, and I'll make sure that that's up and running by tonight. So that's a hypothesis. And then, of course, you'll have the related quiz that's related to today's lecture. Sound good? Makes sense? Have you ever had done a hypothesis before? Anyone in the class? Have you done hypothesis before? It's relatively new, yeah.
Yeah,
You've done it before, Oscar?
I I have done it, but I had to create it and then, restate, the solution for the hypothesis.
Cool. Very cool.
Yeah, so we had, how to create a hypothesis, conclusions, questions, answers.
Yeah, yeah. That
And
yeah, it works. It's
if we can get through the hypothesis.
awesome. Yeah, it works very similar. Yeah. Thank you for sharing, Oscar. Ashanti, have you done a hypothesis before?
With science, yeah.
Cool, awesome. Yeah, it's a similar thing. You know what I mean? Like what you'll do is you're asking inquisitive questions. You're responding to classmates. It's scientific based. So it works the same way. So very cool. It'll be fun, I promise. It's kind of like a more interactive version of a discussion board. Yeah, it's a little bit more entertaining. So cool. Thank you all for sharing. Appreciate that. So, having talking about that, let's jump into today's lecture. Uh, and today's lecture is really what this course is all about, and that is understanding managerial accounting concepts. Principles of Accounting 2, which is this course, has to do with managerial accounting. Now, you might be wondering, Dr. B, how is managerial accounting different from Principles of Accounting 1? I thought Principles 2 was just a continuation. And it is a continuation, but there's a primary difference here. In Principles of Accounting 1, you learned about the financial statements. You learned about the income statement, balance sheet, statement of cash flows, statement of retained earnings. You learned how to build those. You learned about the accounting cycle, the process of accounting, right? You learned about the foundations of accounting. That's what Principles of Accounting 1 focused on. Here in Principles of Accounting 2, we're going to be looking at the managerial side of that. What I mean by that is you'll be able to analyze, make decisions, and understand the cost of business in order to manage the business, right? So that's why we call this managerial accounting concepts. So let's jump into it. So those are the things. The first thing I want to talk about, of course, is ethics. Ethics is at the foundation of everything we do in accounting. Okay, it's the most important thing because ethics tells us that we need to be open, honest, transparent, accountable, ethical. Yeah, that's ethics. And an accounting perspective. Managers need to be ethical. And that's the middle of what it means to be manager. So, uh, managerial accounting. What is it? It's a way where managers look at financial and non-financial information in order to make decisions. Okay, very general sense. Why do we look at managerial accounting? You might be wondering. As a manager, you need to be able to plan and control the business. Planning and controlling. Planning and controlling. It's cyclical. We do this over and over and over again. We plan the business, we execute on the business strategy, we control the results, and then we plan again through evaluation. You see, it's a continuous movement. Planning involves things like planning for property, plant, and equipment, planning for selling in new markets, developing new products. These are the types of things that a business will plan to do. Okay. Part of it might be come from the strategic plan of the business. Some of it might come from the operating plans of the business. We formulate these plans and put them into what we call a strategy to execute on these plans. We execute through the strategy. Okay. Then the results start to come in from the execution of the plan. The results include things like costs, profitability, customer satisfaction. Okay. These are results from your sales, obviously, right? We sell products to generate sales. We make products to sell. We sell the products to generate sales. Those products have costs associated with them and making a product. There's also sales costs. There's also costs for the property, plant, and equipment. There's also costs for running the factory. There's also costs related to customer service. Is the business profitable based off of those sales? Well, you know how to determine that, right? We talked about that last week, profitability, right? I could run a couple of ratios and find out. Yeah, sure you can. But in order to generate a profit, our sales have to be greater than our expenses. Yeah, I mean that's the basics of it, right? Our sales have to be greater than our expenses. It's how we make something profitable. And then other results include things like customer satisfaction. The things that would impact customer satisfaction might be things like the defect rate. Did I make a product that was defective and shipped it out? Customer not happy, they ship it back. I give them a refund or provide them with a non-defective product. Obviously, there's costs associated with those things, right? So it's the cycle of management. We plan, we execute, control, evaluate, replan. Yeah, cyclical. This graph, and I apologize that it's a little blurry. This graph shows us the differences between what you learned in Principles of Accounting 1 and Principles of Accounting 2, right? Both have the same attributions: the users, the purpose, flexibility of reporting, timeliness, the dimension of time, focus, and nature. That second column says financial accounting. That's Principles of Accounting 1. Okay, you learned about the users who were external to the company: investors, creditors, and other people outside of the company. The purpose of financial accounting was to assist these users in making decisions, whether they be investment decisions, lending decisions, or other decisions. In financial accounting, we generated the financial statements: income statement, balance sheet, statement of cash flow, statement of retained earnings. And the way that we developed those financial statements were according to US GAAP, generally accepted accounting principles. And hopefully you remember those principles because they'll come up again. It was important that we generated those financial statements in a timely manner. by month, by quarter, semi-annual, and annual. And the reason why we did that is because we had to make sure that they were auditable in a timely manner. So, because publicly traded companies, they have to file those with the SEC, and everything is time bound, especially for your investors. The time dimension on those were what we called historical, meaning I could look at financial information from the past in order to make future decisions, like budgeting. The focus is on the entire company because we look at income statement, balance sheet, statement of cash flow, statement of retained earnings from a whole company perspective. And the nature, of course, is financial. It's financial accounting. So that was all what we focused on in Principles of Accounting 1. Now, here we are in Principles of Accounting 2. We focus on the inside of the company, the internal users, management, executives like the board of directors, employees, okay, people working inside the company. That's the primary users. The purpose of managerial accounting is to help these internal users to plan and control and make decisions, of course. With respect to managerial accounting, we generate what's called internal reports. The types of internal reports you might see would be like sales reports, production reports, cost of goods manufactured report, uh, customer satisfaction reports, etc. They're all internal, even the budget, right? These are internal reports that never get shared with people outside the company. Right? It's confidential, right? Because of the nature of those internal reports that we focus on managerial accounting, they're flexible. They do not follow generally accepted accounting principles. Why? Because they don't get published. They're available at any given time. They're timely, yeah? Because they don't get audited. Why? Because they're internal reports. Internal reports don't get audited because it's not available to people outside the company. We use those types of reports to, of course, make decisions that are time bound. And the focus is really on things like company projects to possibly expand the business processes to improve the processes to reduce cost. And of course, the focus could also be by division or department rather than on the whole company. So, highly flexible in nature, managerial accounting is. The focus is mostly monetary, meaning we look at things like cost and sales and things like that. But we also look at things like customer service, customer satisfaction, which is non monetary. You see? So that's the primary difference between Principles of Accounting 1, financial accounting, and Principles of Accounting 2, managerial accounting. Earlier, I'd mentioned that ethics is at the center of management and pretty much everything we do. You probably saw this slide before back in Principles of Accounting 1. Because I can already see some of you are like, Dr. B, this looks kind of familiar. The reason why I bring this up again, now in Principles of Accounting 2, is because in management, it's super critical that we do everything we can to prevent fraud from happening. Back in Principles of Accounting 1, we talked about what we call the fraud triangle. And the fraud triangle represents the three different areas that encourage fraud it happening, right? There's an opportunity to commit fraud, meaning, if there's the employees not being monitored, that kind of thing. Rationalization, oh, everyone does it. And financial pressure, oh, those bills are coming up. Got to get that money somehow. Those are the three parts of the fraud triangle. We learned about that in Principles of Accounting 1. So here we are in Principles of Accounting 2, and we got to figure out as a manager ways to prevent this fraud from happening, right? So we establish what's called an internal control system, which is a set of procedures that managers use to prevent fraud. And these typically include these four things. We ensure reliable accounting. Has to be accurate. Okay, it's got to be true and accurate and transparent. Number two, we have to protect our assets at all costs. This would include things like locking our inventory in a safe room, okay, lock and key. Establishing a dual factor authentication for logging into the computer, okay, protects data. Things like security cameras, right? Motion detection systems, security guards. All of these things help to protect the company's assets. Remember, assets are things like property, plant, and equipment, but it also includes things like cash, accounts receivable, yeah, inventory. Yeah, all those are company assets. We got to protect those by those methods we just talked about. The third is, of course, to uphold company policies. As a manager, you've you know what the policies are. Either they were set by someone else at a higher level, or the manager established the policies. You gotta follow the policies and uphold them. Yep. And of course, the last one is to promote efficient operations. These four components create what we call an internal control system. It's a system of procedures established by management to ensure the business is operating efficiently overall. And of course, it helps to prevent fraud from happening. Now, in managerial accounting, which is much different than financial accounting, if you're ever interested in working in managerial accounting, these are the types of career paths that you might follow. And you'll notice that some of these are not necessarily accounting, right? You know, general manager, for example, a general manager of a retail store, a department store, um, of a general business, you know, a service business, general manager. General manager is typically responsible for the financial and non-financial components of the business. And then you see, you know, a couple of different controllers, which is what I used to be back in the day. Chief financial officer, financial analyst, accountants, you know, all these different types of positions. I tell you, there's a lot of different ones out there. Both, and of course, these are both in for-profit businesses, not-for-profit businesses. They all utilize some type of accounting, and they all need management. Or maybe you own your own business, right? So that's you're all of these things. If you own your own business, you know, oftentimes you're a one-person show or two-person show, and you're ultimately you're responsible for your business, and that includes the financial and non-financial aspects. So as an entrepreneur, you need to understand things like costs, budgets, financial statements, etc. And if you're a manager of any sort, you totally understand that you know those things will impact your role. Make sense? Any questions? Cool. Yeah, it's a lot of different careers in managerial accounting. Okay, so I want to talk to you about cost. If you recall, when we first started this course, and I think I even mentioned this last week, is I want you to get into the mindset of manufacturing to understand the different types of costs that a business faces. Okay. Hopefully you remember me saying that. And the reason, again, manufacturing focuses a lot on cost. As a manager, you need to be able to identify these different types of costs, classify them, understand the different levels of these costs, and control them ultimately. Because in management, you get evaluated on your ability to, of course, produce sales, but also to control cost, right? So that's why we talk a lot about cost from a manufacturing perspective in this course. It gets you to understand all the different kinds of costs and how to control them ultimately. So let's talk about cost. There are two types of cost, kind of. There's probably a few more, but there's two classifications, we'll say, of cost. There's what we call direct costs and indirect costs. Okay? Direct costs are costs that you can trace directly to a product or to a process. Okay? Here's a couple of examples of direct costs. Direct labor. Direct labor. These are the employees directly working on manufacturing a product. Okay? Examples of those employees would be assembly line workers. They're physically touching the product, putting the product together. Okay? Well, that's what we call direct labor. We're going to talk a lot about direct labor. The other primary direct cost we have is what we call direct materials. Direct materials make up the majority of the cost of manufacturing a product. In this slide, we have some examples of the direct materials for manufacturing a bicycle. We got the frame. Yeah, that's the majority of for sure. Chain, the tires, the seat, handlebars, brakes, cables, pedals. Those are what we call direct materials. They make up the majority of the cost of manufacturing a bicycle in this example. Okay. The direct labor would be the wages of the people manufacturing the bike. Yeah. And their benefits, cost of their benefits. So that's direct materials and direct labor. Those are the two primary direct costs that you'll hear us talk about over the next 13 weeks.
Professor,
Yes, please.
I have a question.
Go ahead,
We
Oscar.
talk about this is a factory for a bike maker. But when it comes, for example, in a restaurant, how could I know which is the different, which is the right cost and
Yeah.
indirect cost?
Yeah, awesome question, Oscar.
What will it be the one? How can I identify those?
Sure. Yeah, great question, Oscar. So a restaurant is a great example. So for the direct costs involved in the restaurant business would include the ingredients to make a dish. Okay. So your direct costs would include things like, we'll say, produce, meat,
Is
or
it products as a direct cost,
I'm sorry.
like vegetables?
Yeah, yep, yep. Vegetables, produce,
What about the paper, like containers or wraps?
So those containers, we would call those indirect costs. Indirect. The
So I,
reason,
okay.
yeah, yeah, the reason for that is, Oscar, is because they make up a very small part of the cost. You see, like let's say you're in a food truck business, we'll say, okay?
Mhm.
So food truck business, you're making, a couple different products, which are the meals, and you can trace the direct costs, which are the ingredients, yeah, the uh, the the vegetable, the produce, the proteins like meats and poultry and fish and whatever. Uh, you know, those are your direct costs. The indirect costs would be things like the wrap, the foil, the container, the plastic container or whatever. We call those indirect costs. Why? Because we cannot trace the whole cost of all the containers to making one dish, you see? So that's why we call it indirect. And it makes up a very small part of the cost. That's a really good question.
Thanks, Pastor.
Yeah, absolutely. And that leads me into talking about indirect costs. Indirect costs are costs that cannot be directly traced to a product. For example, making a dish at a restaurant. Indirect costs cannot be directly traced. Here's what I mean by this. These types of costs for a bicycle manufacturer would include things like the factory accounting department, factory administration, the rent for the factory, the manager's salary, uh, utilities, insurance, depreciation expense, uh, containers for food. These are indirect costs. Okay, we cannot directly trace them to a single product. That's why we call them indirect. Oscar, in your restaurant example, indirect costs would include things like the rent for the restaurant, okay, the utilities for the restaurant, the lights and the heat and the air conditioning and the water and so forth and so on.
So like cables, internet, or
Yeah, those are all utilities, exactly. Yeah, that would all be indirect cost. Indirect. It will
yeah.
also include things like the insurance for the restaurant. Okay, the equipment depreciation expense for the kitchen equipment. Okay, those are all indirect costs.
So like the stove, the oven, the fryer,
Yeah, but it would
those
be
are under right costs, right?
exactly, that would be indirect costs, but just the depreciation on that equipment.
Hmm. Okay,
Yeah,
thanks.
great, very good. Yeah, absolutely. So that's direct costs and indirect costs. You don't worry so much about memorizing all the different ones, but just know that direct costs are things directly related to making the product. Indirect costs are indirectly related. Okay, they're costs I cannot easily trace. They're there, they're related, but I cannot directly trace them to a single product, you see. Think of them like factory overhead. Factory overhead involves all these indirect costs. They're there, but it's really hard to connect those to a single product, you see. So I had mentioned that direct costs include things like direct materials and direct labor. Direct materials make up the majority of the cost of manufacturing the product. Okay, and I trace those materials directly to the manufacturing of a product. Example, we have the bicycle. Okay, the tires, seats, frames, pedals, brakes, cables are all parts that I use to make the bicycle. Okay, they make up the majority of the cost of manufacturing the bike and to convert it into a finished product, finished good. Then, of course, I have the direct labor. These are the employees that are responsible for making the product. Okay, directly working on the product. In Oscar's early example in the restaurant, the direct labor would be the cooks, the chefs, the line cooks. It's direct labor. Okay, it would also include probably the waiters, waitresses. That's direct labor. They are directly involved in the cost of making the finished product. You see? In the bicycle example, it's the employees that are on the assembly line. They're directly touching the product. They're making the product. You see? Questions? We're doing okay. All right. And then we have this third thing called factory overhead. Okay? This involves your indirect costs. Factory overhead consists of things like indirect costs and we'll say additional cost, yeah, that we cannot directly trace to a single product. You see, this would include things like maintenance workers, which is an indirect labor. Indirect labor, I cannot directly trace their labor to making the product. Examples would be the maintenance workers that clean the shop floor, okay, or the supervisor's salary. The reason why a supervisor's salary is considered indirect labor is because they are not making the product. They're supervising the people that are, but they're not physically there on the assembly line. You see? In Oscar's example of a restaurant, indirect labor would be the restaurant manager. It would also be the people cleaning the tables. It would be the host person. You see? That would be indirect labor. Why? Because they're not directly involved with making of the food. You see? So, indirect labor. Indirect materials. These are materials that make up a very small amount of the cost of the product, and I cannot easily trace it to a single product, you see? That's why in this bicycle example, we have things like screws, nuts, staples. They're very small components that I can't trace to a single individual product. In the restaurant example that Oscar and I just talked about, one would be the containers, the to-go containers for the food, yeah? It would include things like sauces, right? Like the condiments on the table, like the ketchup and the mustard and the relish and the whatever's. Yeah, those are indirect materials in the restaurant. Yeah, uh, so that's example of indirect material. And then we have other indirect costs like factory utilities, the rent, uh, depreciation expense on the equipment. Uh, yeah, exactly. So we lump all these indirect costs together and we call those factory overhead. They're related to the manufacturing of the product, but we cannot directly trace them to a product, you see? Okay, so we learned about direct and indirect costs. We discussed the concepts of direct materials, direct labor, and factory overhead. Now we can further classify direct materials, direct labor, and factory overhead into two other costs. We call these costs prime costs and conversion costs. Okay? Prime costs include both the direct materials and direct labor. We call those prime costs because they make up the majority of the cost of making a product. That makes sense. Then we have what we call conversion costs. Conversion costs are costs that are incurred in converting raw materials into a finished good, which includes both direct labor and factory overhead costs. Direct labor are considered both prime costs and conversion costs for that reason. Direct labor, yeah, I can trace the majority of the costs to making the product, so therefore is a prime cost. However, in order to create a finished product, a finished good, meaning it's done, it has to go through a couple stages, doesn't it? It goes from the beginning to the end of the assembly line. We start it with using some direct materials. We put it into what's called work in process. Work in process is the stage where we're making the product, we're putting things together. It's work in process. We use employees to do that, the direct labor, you see. And what we need is the direct labor plus all those indirect costs. We put those two together to convert the raw materials into a finished good, you see? That's why we call them conversion costs. It's the cost of converting a product from raw materials to finished goods. And it includes direct labor and the indirect costs, you see? Okay, so you know what direct materials are. Those are the materials used to make up the majority of the cost of a product. You know what direct labor is? Those are the employees working on the assembly line, the employees directly involved in making a product. And you know what factory overhead is? It's all the indirect costs that we cannot easily trace. Yep. So we take the direct labor, the direct materials, and the factory overhead together equal the total cost of manufacturing a product. Yeah. So you can say that direct labor plus direct materials plus factory overhead equals the cost of a product. Yeah, absolutely. But obviously not just a single product, it's the cost of manufacturing all the products that the company makes. You see, if you add them all together. There are two other types of costs you need to know about that are not a part of the cost of a product. These are other costs that are incurred related to production, but not a part of production. We call these period costs. These are non-production costs linked to a time period, not to the cost of the product. Okay? Simply put, they're the related activities. like selling and administrative expenses. Selling expenses are the costs to obtain customers' orders and deliver the finished goods to the customer. We call those selling expenses. Examples of selling expenses include things like sales commissions. Commissions are kind of like a percentage of a product that is paid to the salesperson for selling the product. We call that commission. Sales commissions, the salaries of the salespeople, that's a selling expense. Other selling expense would be the cost of delivering the product to the customer. Yeah, those are what we call selling expenses. You can probably also put advertising expense into the selling expenses area. Then we have general and administrative expenses. This would include things like the cost of support staff and administrative functions. This would include things like the accounting office, human resources office, um, the general office, office supplies. You'd find these in general and administrative expenses. Okay? So those are the two types of period costs that you need to know about. So they're related to the product, but not a part of the product cost, you see. So how do you know if it's a product cost or period cost? Simplest way. A product cost are costs I can trace to the product, like direct costs and indirect costs. I can trace into the product. I can trace direct labor, direct materials, and factory overhead to the product. Factory overhead's a little harder, but you get my point. It's a part of making the product. Direct materials, direct labor, factory overhead. Period costs are costs that I cannot directly trace to making the product. So we call this period costs. Selling and administrative expenses. Okay, so this just kind of lists out what we've already talked about. Okay, so where, as a manager, do you think you would see these types of costs in a report? Or you're going to see those in a couple different reports. Okay, so let's say here we are, 2024. We have period costs and product costs accordingly. Product costs, we call those inventory costs. Inventory. Inventory, as you should hopefully know, is what we have to sell to a customer, ultimately, right? That's what inventory is. If you're in a retail business, you purchase your inventory from a vendor. If you're in manufacturing, you're making the inventory to sell to the customer, you see. In manufacturing, we have three different types of inventory that you need to know. The first is called raw materials inventory. Raw materials inventory is just as the name implies, it's raw materials. Examples of raw materials would include things like aluminum to make the frame for the bicycle, right? Rubber to make the tires for the bicycle. Steel to make the chain and the gears for the bicycle. So aluminum, rubber, steel, we call these raw materials. They're unprocessed raw materials. So Three different types of inventory. Raw materials, which we just talked about. The next is called work in process inventory. Work in process inventory. Just as the name implies, it's inventory that's in process. Our employees are processing the raw materials to make a finished product. You see? That's why we call it work in process. Here are the costs involved in work in process. We have the raw materials that we're using, plus we add in direct labor, and we add in some factory overhead at each stage of production. Don't worry too much about that right now, but we'll talk about that soon. So work in process has some direct materials, direct labor, and factory overhead. Work in process. We add it up and add it up as we process it until we get to the third type of inventory. The third type of inventory, we call that finished goods inventory. Finished goods inventory, as the name implies, are finished products. They're ready. Okay? They're ready. And they're available for sale. When a product is ready and available for sale, we call that finished goods inventory. So again, three types of inventory. Raw materials inventory, work in process inventory, and finished goods inventory. These inventories you will find on the balance sheet of the company. When we sell the product, it comes out of finished goods inventory and it goes onto your income statement as cost of goods sold. You see? So that's product cost. For period costs, these are expenses that simply go on your income statement. Right? It's related. It's related. Period costs just go onto the income statement as expenses. Selling and general administrative expenses on your income statement. When we sell finished goods inventory, it becomes cost of goods sold on the income statement. For the inventory that we did not yet sell, the balance is reflected on the balance sheet as raw materials, work in process, and finished goods inventories. So that's reporting product and period costs on the financial statements. For a service company, let's say you have a lawn care business. Okay, you take care of mowing lawns, or at least during the winter, plowing driveways, etc. That type of business, obviously, there's still costs involved, right? Of course there are. We have to classify those costs, and they're generally classified based on things like the direct materials, direct labor, and factory overhead. We classify them a little bit differently, of course, simply because oftentimes there's no direct materials because we're not making a product, right? But we do have direct labor and we do have factory overhead. And we also have selling and general administrative expenses. Those are the costs typically involved in a service company. So I briefly talked about the income statement. The income statement for manufacturing involves sales, right? Minus cost of goods sold, also known as cost of goods manufactured, equals gross profit minus your period costs selling and administrative expenses, equals net income. Yeah, that's what your income statement looks like. And of course, on the balance sheet, we have our assets, liabilities, and equity. Under assets, within inventory, we have raw materials inventory, work in process inventory, and finished goods inventory. That's on the balance sheet. So, again, very important that you remember this. 3 different types of inventory on the balance sheet: raw materials, work in process, and finished goods. Raw materials, just as the name implies, raw materials waiting to be manufactured, waiting to be processed. Yep. Work in process, these are partially completed units. Okay, it's in process. It's on the assembly line. Employees are putting it together with their direct labor, plus a little bit of overhead, plus some direct materials. You see, that's work in process. And then when it's done, when we're done processing, we put the inventory into what's called finished goods. It's ready and available for sale. What does it look like in comparison? So, for a service company, which is a company that does not carry inventory, you see that their balance sheet, there's no inventory. For a merchandise company or a retailer, they have what's called merchandise inventory. Yeah, it's inventory available for sale. They purchased it from a distributor and they sell it to the customer. That's it's called merchandise inventory on a retailer's balance sheet. And then we have manufacturing companies. That's us. We have raw materials, work in process, and finished goods inventories on our balance sheet. So you see, this is the primary difference between the 3 different types of companies. Inventory is the primary difference. So you might be wondering, Dr. B, how do I calculate the cost of goods sold for a manufacturer? And it's got to be a little bit different, right? Yeah, yeah, sure, of course it is. So I want to compare a retailer, merchandiser, to a manufacturer and how they calculate cost of goods sold. In retail, we take the beginning merchandise inventory balance. Okay, what's on my balance sheet at the beginning of the month of the year, plus purchases made. Yeah, I purchased some additional inventory from my distributors, minus ending merchandise inventory balance at the end of the month or end of the year, equals cost of goods sold. So beginning balance plus purchases minus ending inventory equals cost of goods sold for merchandise business. For a manufacturer, we take the beginning finished goods inventory. You see, finished goods inventory, available and ready for sale, plus the cost of goods manufactured. Cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. So that is how you would calculate cost of goods sold for a retailer and a manufacturer. Of course, for this course, I want you to focus on the manufacturer part. It's best to understand all of these different costs from a visual perspective. Okay, and to help you to visualize these costs, we look at what's called the flow of the cost. Yeah. Think about the physical flow when it comes to making a product. Yeah. The physical flow. This slide shows us the physical flow of materials as it moves through the manufacturing process. And you see all of the costs flowing with the physical product. You see? So let's break it down step by step. First, everything starts as raw materials. Yeah. For example, our bicycle manufacturer, we have uh, aluminum, steel, rubber. Uh, those are our raw materials: aluminum, steel, and rubber, and we'll say some uh, gears or whatever. So those are our raw materials: aluminum, steel, and rubber. I need those raw materials to create a bicycle. So the first thing I do is figure out how much raw materials I got. And the way I do that is I take my beginning balance raw materials inventory plus any raw materials purchases. Okay, that makes sense. So that's how I calculate raw materials inventory. Now, obviously, this balance is going to keep updating as I'm using the raw materials. So I got my beginning balance plus my purchases, and then I'm going to subtract the raw materials inventory that has been what we call requisitioned. The word requisition means I'm requesting the use of the raw materials for work in process. We call that requisitioning. One time in your life, you may have filled out what's called a requisition form. A requisition form is requesting the use of an asset. That's what a requisition form is. So you fill it out. The requisition form. You're in You're in your work in process department. You fill out the requisition form. You hand that off to the raw materials inventory department, and they send you the materials that you're requesting, requisitioning. You see. So minus materials requisition equals ending balance raw materials inventory. So that raw materials comes over to work in process. We call this the production area. We're producing the product, the assembly line. Okay, so we have work in process inventory, beginning balance, plus direct materials used. This is the direct materials I requisition from raw materials. Plus direct labor used. These are the employees' wages of the employees working on making the product. Direct labor. Okay. Plus factory overhead used. How much of the square foot of the facility did I use for the rent? How much of utilities? How much of indirect labor, etc. How much did I use in the manufacturing of that product? So I add those things together. That equals my work in process inventory. Then, when I'm done making the product, it becomes what we call finished goods inventory. All of those costs from work in process flow into the finished product. Finished product moves into finished goods, which is finished goods inventory. So finished goods inventory plus goods manufactured, right? And then when I sell, if I don't sell the product, it becomes ending finished goods inventory. If I sell the product, it becomes cost of goods sold. You see, it's all about following the physical flow. If you think in your mind how making a product works, you follow the physical flow, all of the cost flows with that product as it's being made. You see? That's the way I want you to think about it. Helps get you in that mindset. I talked briefly about the cost of goods manufactured. Cost of goods manufactured. If there's a formula to calculate the cost of goods manufactured, and the cost of goods manufactured shows up on what we call a schedule. It's an internal report used by management in order to understand the total cost of making a product. Here's how it works. We take direct materials used plus direct labor plus factory overhead equals the total cost of manufacturing plus beginning work in process inventory minus ending work in process inventory equals cost of goods manufactured. Okay? It's a very specific formula, one that you'll need to follow as you're calculating cost of goods manufactured. I promise that'll probably show up in a quiz. Hint, hint. This is what the report looks like, the cost of goods manufactured report, also known as the schedule of the cost of goods manufactured. At the top, we got the direct materials, plus number 2, direct labor, plus number 3, factory overhead, equals total manufacturing costs, plus beginning work in process, minus ending work in process, equals cost of goods manufactured. Yes, please, Oscar.
Yeah, so this statement, is that an Excel spreadsheet? Or where can we do this?
It can be, yeah. You can definitely do this in Excel. Absolutely.
So
Yeah.
this is basically a manufacturing statement spreadsheet Excel.
Yeah. And that's typically how a lot of manufacturers would show this type of report. They also might use some accounting software like an enterprise resource planning system.
I saw that I believe it can be done on QuickBooks as well, isn't
Yes,
it?
it can be done on QuickBooks. That's right. Yep.
Yeah, I think I saw one of those on the QuickBook when I was doing that.
That's how I recommend you do it because doing it in Excel, I have no problem with Excel. I like Excel, but it's limited. It's hard to visualize. It's hard to visualize in Excel. So that's why using like QuickBooks or something like that is a little bit more efficient.
All right, thanks.
You're welcome. Yeah, great question. So another way of looking at the cost of goods manufactured uh, is through this flow of the formula. So total cost of manufacturing, as you know, is direct materials plus direct labor plus factory overhead, which equal the total cost of manufacturing. So we take that plus beginning work in process inventory minus ending work in process inventory to get the cost of goods manufactured. It's the same exact formula that I just showed you a little bit ago. It's just another way of looking at it from a flow perspective. The manufacturing costs flow, of course, across accounting statements, as we learned about just a little bit ago. As I had mentioned, the cost of goods manufactured ultimately is represented in the cost of goods sold, right? That's shows you how it flows from that report. And if it's not sold, it flows onto the balance sheet as work in process inventory. And of course, as it becomes sold, it flows off of the balance sheet from finished goods inventory and becomes a part of cost of goods sold. You see, so this just kind of shows you how the financial statements are connected to the schedule of the cost of goods manufactured, that internal document that we use. So, before we end today's lecture, I just want to talk very briefly about some trends in accounting that you're noticing. Everything's becoming digital, especially today. There's a lot of artificial intelligence and automation and things like that in accounting to help us as accountants and as managers to focus more of our attention on running the business. Yeah. So digital manufacturing is becoming a very big thing. A lot of processes are being automated. Uh, there's a larger focus on the customers' needs, what's happening in the global economy, that kind of thing. So these are current trends that affect accounting. At the end, of course, affect the business. One of those is called lean manufacturing. It's or what we call lean principle. Whether you're in manufacturing or a service business or the restaurant business or whatever, it's important that your business operates in what we call a lean way. What that means is you're focusing more of your attention uh, on on reducing costs and improving the customer experience. Okay. Another method of this, we call this just-in-time manufacturing. You may have heard of this. Uh, one, a large automobile manufacturer, Toyota, they use what's called just-in-time manufacturing, where they will not create the car until they receive an order, until they receive the customer's order. So they'll make the vehicle just in time for it to be delivered to the customer. The same concept applies in the restaurant industry. Oftentimes, restaurants do not make a meal in advance. They wait until they get the customer's order to make the meal, right? We call it just in time, right? That's how it comes out fresh every time. So same concept. It's called lean principles. And of course, there's a large focus on quality. Quality is huge. So we look at defect rates. We look at ways to improve our processes in order to prevent defects from happening. It's a way to eliminate waste, right? I'd mentioned just in time. We receive the customer order, put it into production. We receive all the raw materials just in time for the production process, and of course, we ship to the customer just in time. Another growing concept, and you're learning about this more and more, is called value chain. Value chain is where we add value at every step of the process from the point of acquiring raw materials all the way to the point of delivering the final product to the customer and follow-up service with that customer. Helps to improve efficiencies and profitability, of course. And then one of the last trends to talk about today is called the corporate social responsibility, where a lot of businesses today are becoming more responsible for things like the environment, the natural environment, the social environment, etc. Going beyond this, just the point of profitability, but also becoming more responsible for people, the planet, and profits. And then the last thing I want to talk to you about today before I let you go, it wouldn't be accounting without at least one or two ratios, right? So one of those ratios we use is called raw materials inventory turnover. It tells us how efficient we are at using our raw materials. Okay, how quickly I'm going through it. And the way we calculate that is we take raw materials used divided by average raw materials inventory. Just as we talked about last week, when you hear the word average, we're talking beginning balance plus ending balance divided by 2. That's raw materials inventory turnover. And the last one is called days sales and raw materials inventory, where we take the ending raw materials inventory divided by the raw materials used times 365 days. And that, my friends, is the end of today's discussion on managerial accounting concepts and principles. Again, this is the very beginning of this part of the course where we're going to focus a lot on cost as we move forward. So, what you need to do for Wednesday is I want you to please focus your attention on the hypothesis, which I'm going to fix that link right now to make sure that it works appropriately. You'll create your own hypothesis, respond to one of your classmates, and also on Wednesday to take the Chapter 18 quiz. Those are your only two action items for this Wednesday. Both of them, of course, are due on Sunday, but I want you to use your class time on Wednesday appropriately by completing those two things. Are there any comments, questions, concerns, anything like that? Any questions at all before I let you all go? You're all good? Really? Okay. I trust you. I do. So, as always, thank you so much for your time today. I appreciate every single one of you. I'm glad that you enjoyed it. If you ever need anything, you can email me, call me, set up office hours, whatever you need, I'm here for you, okay? I wish you all the best. Thank you so much for your time. Take care. Have a wonderful rest of your night. Thank you so much.
Thank you,
Professor,
You too.
Professor.
Thank
Thank
you.
you. Thank you. Appreciate all of you.
Professor.